So without further ado, I would like to invite Dr. Y to chair this session, please.
Very much. Good afternoon, everybody. I am very envious of you all having the wonderful food of Penang, while I had to eat a Subway sandwich in my house for this conference. So I will come back with a vengeance to Penang. Firstly, I'd like to thank the organizers for organizing this fantastic conference. I've been sitting in from this morning. I've learned a lot. And this afternoon's symposium, this lunch symposium, is a very important topic. In fact, I just last Friday met up with my wealth advisor. Not that I got wealth. He still hasn't classified me as whether I got any net worth. But as I may have to work till I die because I have no retirement plan. So I'm going to be asking a lot of meaningful questions, and I hope you also will have. We have a fantastic panel with us today who are very local in their perspective, and so especially for the Malaysians, they have some fantastic strategies, I think. So I will proceed. Can I have the first slide, please? Alex, first slide. Thank you. So, yeah, well, you can move. This one, no need to know. I'm just based in Singapore. Okay, these are our panelists, very distinguished panelists that we have here today. We are very fortunate with, we have Steve Lim, the Chief Learning Officer. I like that. I'm into education, and I think all the world's problems are solved by learning and teaching. And it's interesting to see somebody of an accounting and finance background taking up this position. So Steve's has got a very extensive experience and background in various financial instruments as part of your retirement planning. And so he comes from Afin Wang's Asset Management Berhad, the Chief Learning Officer. So this will be an important component of his portfolio to educate us on how to plan for our retirement, that we don't end up on the streets, in the future. So, so without any further ado, I'm going to get Steve to. Or do you want me to introduce everybody? I think we finished all introduction. Next we have is Mr. Hussein from the PPA, which I just found out is the Private Pension Administrator, which is part of the Private Retirement Scheme, which is from is an inception from the Securities Commission. It helps to manage your retirement package that if you so choose to. I suppose it's something that carries on from EPF. I think we will leave it to him to explain how PPA. He again comes from very technical background of actuarial mathematics. He's got a lot of experience, not only from the oil and gas industry, but also from consulting at KPMG. So we hope to hear from him on the mechanics of how we can be assured of our retirement. Next, we come to Patrick. Patrick Chow is from Sun Life, who's a Chief Product Officer. So it'll be interesting to see some of the products that he will have from the insurance industry that will ensure an equitable guarantee for retirement sufficient funds that we can retire comfortably. And so without further ado, let's get the ball rolling with Steve with his first lecture.
Hi, good afternoon. Are you guys comfortable if I take off my mask? Because I think we are far enough. And when you were having your lunch, your mask was off or two, right? Because I was choking. Okay, my name is Steve. I'm the Chief Learning Officer of Afin Huang Asset Management. We are the On the private side, I think we are probably the second largest asset manager in Malaysia, after our big brother, Public Mutual. I myself have been in the capital market for the last 32 years. So anything to do with investment and all that, I would have an opinion. Okay. The first question, the first discussion we're going to handle today is what are the wealth strategy. The wealth strategies are wealth strategy. Whether it's bull market or bear market, they are immutable. You don't have to change it that much. There are three things that I want to talk about in regards to wealth strategy. From my experience, talking to clients, whether it's institution or mainly individual, it could be an individual wage earner in the 20s or 30s, or somebody who is already quite established, amassed quite a bit of wealth in their 40s and 50s or 60s. I used to be a private banker in Singapore. The common mistake I have come across regards to wealth preservation or managing their own fund is either they take too much risk or they take too little risk. Let me explain. I think it's very important, you as an individual, when you're trying to decide where to put your money, you have to understand two things, okay? The first thing is risk tolerance. The other thing is risk capability. Risk tolerance and risk capability are two very, very different things. Risk tolerance is, I grew up in a very, just an example, I grew up in a very conservative family. Both of my parents are teachers. They worked their way up from the bottom to become somebody, okay? So they are very, very afraid of losing money, putting money in the stock market or buying some funds and losing money. So from the upbringing, I'm naturally or brought up a very conservative person, okay? I don't take a lot of risk, okay? That's my risk tolerance. You can be 25, your risk tolerance is very low. You can be 65, your risk tolerance is very high. I'll just give you another example. I grew up in an entrepreneurial family. Okay, my dad was a businessman. He tried one thing, he made a lot of money, but he went above board, then he lost all his money. Then he came back, jumping into another business and became wealthy again. So that sort of family, they have gone through ups and downs. Typically, they are brought up to be risk taker. They're very, very comfortable taking risks or enduring risks. If they buy a stock, tomorrow it drops 10-20%, they can sleep very well knowing that the next day, or the next month or the next year, you will recover. Okay, certain people are very, very comfortable taking risks. So those are risk seeker. Okay, so that's tolerance. That's your upbringing, or you are just born to be like that. But risk capability is, if I'm in my 60s, okay, I'm in my 50s right now. If somebody will come to me and say, let's go and buy this, I've got a very, very interesting tech idea, you know, bucket shop idea. The company is very small, but it's growing very, very rapidly. You know, should I put 50% of my investable fund into this counter? The 50-year-old, 60-year-old guy may decide to put money in it. That his risk tolerance is very high, but at 60, let's say 65, his risk capability is actually very low. If he loses the money, the time he is left to make back is substantially shorter than a guy starting off at 25 years old. So at 25 years old, my risk capability or risk ability is actually very high. So what I'm saying is, if you are in your 20s and you're putting all your money in FDs, you're not doing yourself a favor and you're not planning the money properly, because you can withstand the fluctuation of the market over the next 20-30 years until you retire. You have a lot of time to come back. Okay, you just put your money in some funds or some ETF, let's say S&P 500 ETF, that has done something like 11% per annum over the last 30 years regularly, you can't go that wrong. 30 years later, you'll be up at least 11% per annum. You're probably up a few hundred or a few thousand%. Okay? But for the guy in their 60s, they would probably have to allocate their assets according to how much risk or how much income were to come in until they one day call it quit and just retire and no more income is coming in. Okay, so you gotta ask yourself, you quantify yourself. If you really don't know, try to get sign up an account with any of the investment advisor, unit trust or whatever. There is what we call a suitability assessment test. You take the test, I think about 5 to 10 questions, you pretty much will know your risk tolerance. Okay, but if you are naturally, if you are, let's say you're 65 and you're sitting on 50, 100 million, and somebody were to come to you to say, let's invest in 100,000, that's considered low risk, regardless of whether the investment is high risk or low risk. Okay, so that's the first thing. You must know whether you are taking the appropriate level of risk according to your tolerance and according to your ability. Okay. The second thing I want to talk about, so when I come to you to say, Dr. So-and-so, let's invest in this very, very interesting fund that invests in nuclear power. Okay, nuclear power is an in thing right now because you remember, I mean, if you are following closely, oil prices shot up to $140 the other day, now retreated, settling around about 100 something. Okay, and the reason why oil prices has shot up, I mean, is another lecture lah. Okay, we can talk for hours as to how the ESG theme, ESG initiative has resulted massive underinvestment in the fossil fuel. So much so that the fossil fuel, as in our natural gas, our petroleum and all that, the production could not catch up, with the demand at the moment. So if somebody were to sell you something high risk, high return, and you are 65 years old, it should be a satellite investment, what we call. And a satellite, if you combine all the satellites, all the sexy and interesting and risky ideas, as long as they are small enough, it should not shake the mothership of your core investment. So your core investment could be your property, could be your FD, could be your lower risk bond portfolio, or maybe something that has got a fixed maturity. In 3 years, you will get your money back. Meanwhile, you will get maybe 4-5% return kind of fixed maturity sort of fund. That should be your core, okay, if you are in your 60s. But if you are in your 25, in your 20s or 30s, okay, you still have many years to accumulate your wealth. This particular concept would not apply that much, but your core, you can afford to have your core to be something more, something riskier, say a dividend fund. I like to invest in stocks because I want to see 10, 15, 20% kind of return. And because it's core, I want it to be income generative. I buy something that will give me a regular dividends, just like blue chip fund, okay, blue chip stocks. But meanwhile, my satellite, I can still do adventurous thing, okay. So if my friends were to come to me and say, hey, check out this NFT. Do you know what NFT is? Non-fungible token. Okay, so that's a new thing that the young people like to invest. That is extremely high risk, but also extremely high return. So this, for a young person, these will be their satellites. It could be NFT, it could be a tech fund, it could be a tech stocks or whatever. But their core will be maybe equity, but slightly lower risk sort of equity, like maybe a value fund, a value stocks, or a dividend stocks or blue chips. Not growth, growth is quite high. Okay, The third concept in terms of wealth preservation that I want to talk about is, okay, market is not very good right now. Okay, if you look at, I just give you an example. I just look at the chart of Alibaba. Alibaba is a Chinese tech stocks. Alibaba has gone up from IPO all the way to a few $100. Do you know it has come down almost to IPO price? Okay, so it has done very well, but it has corrected because of various factors, tech crackdown, and now with the Ukraine war, people are viewing China as one basket with the Russian. So if you are investing in China right now, people are worried that your assets may get nationalized, like what Putin did to McDonald's, KFC, and all the American interests or the Western interests in Russia. So, if I have, say, 500,000 to invest today, okay, and I am 55 years old, okay, 5 more years to retirement, I don't expect much money to come in. I have to be a bit more careful. So I got lump sum 500,000 all sitting in FD right now. What do I do about it? I can adopt lump sum as in the 500,000. I talked to one of our very, very capable financial advisor. Okay, he or she will look at your 500,000 and give you a proposal as to where you should put your money. Okay, how many percent in fixed income, how many percent in equity, and all that, according to the two things that I mentioned just now: risk tolerance and your risk capability. That's lump sum. I have to do asset allocation. There are also irresponsible financial advisors out there who wants to make the maximum fee they can make out of you. Okay, when they sell you an equity fund, they would derive more income from fee from you. So 55 years old, after doing the suitability assessment test, they still push very high risk, volatile funds to you. Okay, then in a market like this, you see your portfolio down 20% and you're not very happy with it. Okay, so that's lump sum. The other way to do it is what we call a dollar cost averaging. Okay, dollar cost averaging is probably one of the most sensible and the most powerful way to invest. Okay, I will show you a chart later. Okay, it's very telling. I have been doing dollar cost averaging for my kids' education, two kids' education, my own retirement fund, over the last at least 20 years. Okay, my son is in US today. He's working there, all funded by this DCA method. My daughter has just gone over to Monash, Melbourne. Okay, it's all funded by regular, very disciplined savings into something that will grow maybe at least about 8% per annum. Okay, so this is what we call DCA. The method itself has got a risk management mechanism attached to it. Why? Because if every month I'm just allocating $1,000 from my salary into their retirement, into their education fund, when the market is up, I will be buying less unit. My 1,000 will be buying less of whatever investment I've decided to put in. If the market is down, I will be buying more with that same 1,000. Because the prices has come down, I'm buying more, right? So this DCA method itself has got a buy low, sell high risk management mechanism embedded in it without you realizing it. Okay, so I just talk about lump sum is for somebody who has got the money and he has to decide how to allocate it. The second is discounted cash, the dollar cost averaging. More suitable for somebody very young. You can start very, very young at 25 dollar cost all the way to your retirement. You will have a very, very handsome retirement sum. Okay, what if I am 55, I'm risk averse, but I still want to do DCA? Yes, of course. You put your money lump sum in something very, very stable, let's say a FD or money market fund or whatever, but you give instruction to your financial advisor or your bankers to take the money there from the lump sum, gradually DCA into something a bit more higher return or higher risk. You can do that, okay? That's a hybrid between a lump sum asset allocation and a DCA. Of course, you're 55, you're thinking of DCing until you're 65, 10 years. 10 years, you cannot expect the kind of big nest egg you will accumulate compared with the guy in your 20s and to save for 30 years, okay? Yeah. So essentially, these are the three things, the three major investment, I would say, mechanics that I think each and every one of us, whether you are managing a big sum of money or whether you don't have money but you are very disciplined, you're willing to part with 500, 1,000 or a few thousand bucks every month, you know, to accumulate into something humongous. Okay? Yeah.
Okay, thank you,
Yeah.
Steve. We'll move on. Can I ask the same question to Mr. Hussaini? Can I just, we are generally public, we are elderly individuals, so just taking that into account, I would like to ask Mr. Hussaini, if you have a 65-year-old, I'm 65 years old, don't have much assets, you know, typical middle-class individual, live life, brought up kids and everything, what would I got a house, maybe I bought a house, I own a house, have a small life insurance sitting somewhere, coming out. What would your advice be to somebody in this age group for a strategy for investment?
Okay. You mentioned about 55 years old.
Yeah.
I think at that age, we need to be more concerned or place more interest into preserving capital.
Yes.
Because in terms of investment, the horizon, the time horizon, you know, it's not to our advantage in that sense where we can't be putting our savings into high-risk asset classes. Like, for example, you want to invest in China stock market and all that. Even Hong Kong is very volatile. And so I would say that at this point, you consider what you aim to get in return, because you don't have long time to recover in case something very volatile happen. So I think it's best that this kind of thing you discuss with a financial planner who need to look at your overall risk appetites, your overall capital, where they are parked now, and so on and so forth. It's not a simple answer to give under the current volatility that we are seeing.
Okay, but you know, the main concerns of somebody in that age group would be some form of retirement, you know, benefit in the sense of being able to live out the golden years. So, I mean, we have EPF as one sort of thing which is going to give out that lump sum thing. Is there anything else? Let's say somebody's got 10 more years of fruitful life in terms of earning that you could suggest?
Those who have savings in EPF at the moment, let's say, and you are 55, you're about to go into retirement, that's where you need to look at how to spend the savings. It's not so much about how to save or how to invest their money so much, because I think let's accept reality that unless you are still working with monthly income, then you can still invest in some other asset classes or some other investment option in order to complement EPF. But if you only have EPF for your retirement savings, then you need to be careful in terms of how you want to spend, how you want to increase or find a better return, for example, because high return always have higher risk. So that's something you need to consider as well. As I said, it's it's not so simple to try to give advice who are about to go into retirement in terms of how or where to save or how to invest their savings they have in EPF.
Okay.
By the way, I just got a notice that government has just allowed another 10,000 withdrawal from EPF. That just
Okay.
came in, and I think this is going to be a further challenge to those who have savings in EPF that they can go and take out, and that would reduce their future savings.
Yes. Yeah.
Now,
Thank you. Can I ask Patrick, is there any product that you could recommend for somebody who's in the tail end of their career that would be there that can help them to put, say, maybe a lump sum and then which have a guaranteed kind of a retirement return?
Yeah. I think in the market there are quite a few insurance products that offer, I would say, not so much about protection, but it's more on more stable return. Because we believe that at that point, when you're closer to your retirement, your risk is not dying prematurely. Your risk is actually living too long. So the amount of protection you need is actually not as much. Whereas you probably need a more, some vehicle for you to get some sort of principal protection and also a more stable return. Of course, the upside is not going to be as much as, where you invest in, the stock market. However, insurance, it gives you sort of a peace of mind that, your principal at least is protected, and it gives you a very stable return in the long run. And also to add on that, usually this kind of product, underwriting is not that stringent. I understand, if you want to get, a lot of protection, underwriting could become an issue depending on your health status. But the market, the insurance companies also understand that, at that point in your life stage, not everybody will be in perfect health. So these kind of insurance products will provide, not so much protection, but it's more towards, the savings and also stable return element. And the underwriting will be very, very lenient and very easy, to get on board.
Can I just ask any of the panelists who can answer, if you can just think of a product, because it's nice to hear all this, but for somebody like me who's not financially intelligent, I don't understand much thing, but I very simply say, I am 55 now, I've got 10 years to work some more, I got some income coming, and I've owned a property, maybe a $1 million property, plus 500,000 in EPF. What is it that I can get that ensures me, I stay in my property and have, say, 5,000 a month? Is there a product, something, and how much would that product cost me? Of reasonable good health, I'm not going to die soon or something.
Your, Dr. Vai, your 5,000 per month, are we talking about 5% return
just
per
cost
annum?
of living. I own my car, I own my house, It's a very practical question. So
Yeah.
I kind of just need 5,000 ringgit to survive. Is there any kind of product or something that I can do without liquidating my property? So I need to stay in my property. I've got a $500,000 in EPF that I can collect.
$500,000 in EPF, is it? And you don't have any cash at all. You are still working?
Government
or?
servant, very difficult without much cash,
But okay, you have your 1 million property, you have your 500,000 in EPF.
So I said the
What
property,
else do you have?
At least 2 million, a bungalow house in town somewhere about 2 million ringgit.
About 2 million, and you don't have any cash, not at all.
But not significant amount, because the main saving is in EPF, which is what I gather. I'm not sure, I'm out of the scene, but in Malaysia, that's what a lot of kind of non-wealthy individuals would have.
But you're still working, right?
Yeah, so it's got, say, forecasted another 10 years of working here.
So this 5,000 is not going to come from your job. You want this 5,000 from your investment, is it?
So you assume that he's going to retire at 65, so 10 years time. So
Okay.
after 65, he wants to retire and he's happy with the 5,000 a month income.
Okay, then your 5,000, you will have to work backwards. Okay, you have to work backwards. You will to put in something that will give you 5% return. okay, whether in the form of an ETF or in the form of some sort of fund, some form of bond fund or income fund, they will give you something like 4 or 5%. You're going to work backwards. Within these 10 years, you will have to accumulate that sum, okay, to reach there. Let me just do a very quick calculation. So for a 5,000 per month, we're talking about 60,000 per year. Okay, 60,000 per year divided by, let's say, 5%. I will need 1.2 million. You will need 1.2 million to be parked aside to accumulate, to generate the 5,000 for you, based on 5%. Okay, you already got 500,000 in the EPF, right? So you need 700,000 within the next 10 years.
So is there a product out there that somebody could buy that would give that kind of a 5% guaranteed return?
There is no 5% guaranteed return in the market,
Okay.
Dr. Vai, because our FD is 2%.
Yeah.
Yeah.
But are there like an instrument, like for example, a product, an insurance product, an investment product that would do something like that? I mean, I'm just asking, you know. I think that would be pretty. So am I right to say ETF? I mean, ETF would be the best option now.
At this moment, yes. Yeah, EBF is giving, for the last few years, has been maintaining at 5%. But you will have to assume that going forward, they will continue to give you 5% or more. Yeah.
Okay.
Then on top of that, if you are looking at 5% sort of return, you will be some kind of bond fund or income fund or some sort of balance fund with a combination of bond and dividend stocks. Okay, but those are not guaranteed. Okay, there are investment risks. Okay.
Yeah, thanks. Okay, anybody else want to add something to that?
Yeah, maybe I can add on. You know,
Yeah.
in the insurance market, some of the products, they do provide some sort of guarantee return, but it only ranges from 1 to 2% per annum based on the current interest rate and investment market environment. Even globally, you know, if you go to the US or offshore, you know, interest rates are even lower than Malaysia interest rate. So in general, I would say, you know, on the guarantee part, it's about 1 to 2%. On 2% on the high side, and on average is about 1%. So these kind of insurance product will be able to provide the principal guarantee and what I call a stable return. You know, so I would suggest that, you know, you come up with the investment portfolio and do diversify, you know, your assets. You know, put part of the money, you know, insurance part of money in, I would say maybe bond fund, fixed income fund, or even equity fund according to your risk profile. If you're in your case, you know, you have, you know, say 5,000 ringgit a month to invest, right? So in the market there are, and you are about 10 years from your retirement. In the markets there are insurance products that are what we call 10 years payment term. So you can pay for 10 years, and then your money will accumulate. You know, and it will provide you some steady cash flow for about 20 to 30 years. So there are insurance products like that in the market. However, you know, I have to say that, you know, it's not going to, you know, meet your requirement of 5% guaranteed return. It's in this kind of investment environment, it's almost impossible to provide that. You know.
Dr. Bai, I just want to add, the word guarantee is very, very sensitive. Okay, in the eye of the regulator. If somebody were to come to you to offer you something that has got a guaranteed return of more than, I would say, our FD of 1.6 to 2%, anything more than that guaranteed is very, very likely not legit. Because when somebody says, I guarantee you something, the guarantee has to come from a third party. The product structurer in this case will have to go to the bank to ask for a bank guarantee to guarantee you the capital. Otherwise, they cannot say guarantee. It is against the law. you get into trouble with the Security Commission. Yeah.
I think what I was trying to say is not so much a guarantee of return of investment as more as the guaranteed pension scheme. So from my understanding, the government is going to be very difficult. Like only civil servants get guaranteed pension fund. But as we're looking towards our own personal taking responsibility for ourselves to have some form of a pension fund, because when I die, I don't need to have money. Seriously, when you die, you don't need money. It's only when I'm alive I need money. When I die, my children, yeah, you want to say you want to leave an estate, but it's for them to enjoy. I work hard. So I want to see how a lot of people, I mean, I'm in that group where we go negligent in our savings, you know, we spend a lot. In that sort of situation, how do we face our retirement? What I would, and I work it out, I want to live a very prudent life. I'm not going to be extravagant. 5,000 ringgit, I think, for one person to live a month in retirement, you own a house and a car, I assume is doable. I don't know what's happened now, you know, with the situation. So, guaranteed, not return, but a pension. So, if there are products that where I don't get back my endowment, I mean my principal. So, if I can invest in something, say I got $1 million, I put it aside, I buy a product that 10 years from now would give me 5,000 a month, but when I die, everything else goes away with it, which I don't mind, you know. Are there such things where the capital can be taken out, somebody manages it wisely, takes out part of the capital to give your return, at the same time invest the other to make sure that it doesn't depreciate?
Yeah, in retirement planning, we have a method to basically plan it in such a way that you draw a certain sum every month and you deplete it, say,
Yes.
over the next 20 years. In insurance, I believe it's called annuity. Maybe you want to talk a little bit about annuity?
Yeah, those are what we call annuity products. But even those kind of products, usually the guarantee return, the guarantee portion, you know, it hovers around 1 to 2% per annum. There is non-guarantee portion, you know, the total return could be higher, but that's not guaranteed. It's subject to, you know, of course, the investment performance or interest rate environment. But they are insurance products like that available.
Okay.
Let me just add, the government of Malaysia recently introduced this scheme for homeowners. Because you say you have a 1 million ringgit worth of home, you can actually sign up and they will monetize your ownership. You must have fully owned a house, it's not under mortgage and all that. And they will work out, I would say, streams of income for you. It may not be much because they have to consider the value in the future and all that, but there will be some income to sustain 20, 30 years for the future. Schemes are schemes are
I think that's what I was looking at, because you know, for the wealthy it's never a problem. For the simple civil servant or somebody who's, you know, just there, who never thought about it, which now brings me to my next question. Again, I'll put it out to the panelists as a whole. When is the best time to start planning for retirement? For me, it's all too late. I can see from what you guys tell me. But for somebody who's younger, the children of our participants, when is best to start planning for retirement? And what are the strategies that you would take? Hussein, would you want to take that first? Yeah.
May I have, can you start a slide?
Alex?
I have some slides for that.
Number 13, please, Alex. Number 14, I think, yeah.
Essentially, when we work up to, let's assume age 60, yeah? And this one I'm talking about those in the private sectors who have to save under EPF, being a private sector. And I understand a number of us are in the gig economy where you do your own work, you can retire as and when you like. And after, when you're working up to 60 years, that's why you build your wealth, you grow your family, you look after your health and all that. And then up to age of 80, for example, for planning purposes, you should have enough to sustain you for 20 years. And I put a little note there about defined benefits and defined contribution. You talk about pension and all that. So for those who are in the government sectors, and in some European countries, they don't contribute anything per se, but they have guaranteed benefits as part of their job. Yeah? And for the rest of us who are in the private sector, we have to contribute under the law some portion to EPF or other defined mandatory contribution, a mandatory scheme. And then when you turn 60, whatever savings you have from that scheme, that's the money you use to sustain. And obviously the best way to start is always as early as you can. Next step, please. Next slide, please. So there are three retirement concerns that we need to think about. One is, next slide, please. Adequacy, meaning how much. Yeah, how much you need to set aside, how much you need to have in order to maintain the same lifestyle. We're talking about maintaining the same lifestyle, and not about go back kampung and live frugally and all that. So maintain the same lifestyle. We want to aim for 2/3 of your last round salary. 2/3 because the other 1/3 you already not going to have when you don't work. Like for example, paying EPF, paying tax and all that. So just assume 2/3 of your last round salary. That's the kind of income you need to look at when you look at to receive monthly when you retire. And how to get 2/3? The projection talk about setting aside 1/3 now. 1/3 may sound a lot, but if you look at the breakdown there, 23% already gone to EPF. So we just need to save additional 10%. Yeah? Next slide, please. Sufficiency. How long you need to save for, or how long you need to have the savings for. All over the world, women folks tend to live longer than men folks, about five years. So same in Malaysia. So in general, for planning purposes, we say 20 years. You need to have savings enough to cover you 20 years from the time you retire at the age of 60. Next slide, please. Okay, sustainability, or how strong. How strong means about how can your savings take care of inflation. And this is common knowledge that what costs, whatever you have now will cost more in the future. So your savings should be enough for you to sustain your lifestyle up to age of 80, for example, and should also be strong enough to look after the risk, the impact of insurance, the impact of inflation. So in general, if you go to the next slide, please. These are the simple steps, very simple step. One, you need to set up a different job for retirement savings. You don't have, like now EPF, everything comes out from there, education, housing, and all that. So the best way to plan is to set up a different job for retirement savings. You start now, no matter where you are, start now. You can start small, but as you grow your career, you may want to go back and add a bit more as your career grows. And this is also important, save before you spend. Save before you spend, meaning you don't want to say that, oh, I will save after, at the end of the month, see how much I have left. No. You will not have enough at the end of the month. You should set aside, by the time you get your money, your salary, set aside first for saving and then spend the rest. And now the fourth one also important, save regularly. Come what may, make sure every month you save. And lastly, don't forget to nominate so that your next of kin won't have any hassle to get your savings when you are no longer around. So I've got some slides to go over the PRS funds. Can you go next one? PRS is voluntary, is introduced by the government in 2012. Next. You can choose your own funds. We have 58 funds in Sharia and conventional from all kinds of asset classes, from low risk to high risk, or you can leave it to providers to set for you based on your age group. Next, please. Yeah, next one is PRS is designed for retirement, and there's a tax relief for up to 3,000 for those who to save on an annual basis. It's affordable, flexible, up to 8 providers, and is regulated by Securities Commission. Next, please. So how you start is you can talk to providers. We have Afin Huang in the house today, but there are other 7 providers you can choose from. There are over 27,000 consultants that you can talk to as well, or you can go to our online portal, PRS Online, to save if you know what you're doing. Yeah? Okay, that's it for now that I can cover.
Patrick, do you have anything you want to add to that?
Yes, if Alex, if you could turn to this page. Yeah. So my advice is also, of course, I echo Encik Husseini's comments. Is to, of course, to save, start saving for retirement as early as possible. I'm going to use a very simple example. Assuming there are 3 individuals, each of them, they all want to, save up 10,000 ringgit per year, for retirement. They plan to retire at 60 years old. The first one started saving at when he was age 20. Second one started saving when he was age 30. And then the third one started saving when he was age 40. So here's the expected, assuming a 5% return, which is, I would say, still very doable in this on the long run. It's not guaranteed every year, but on average, 5% per year, I think is highly doable. The first individual who started savings for retirement at age 20, he's expected to get 1.26 million when he retires. Whereas the next individual who started 10 years later is only getting half of that, around slightly less than 700,000. Okay, and the third individual, who only started saving at age 40, he's only expected to get 347,000 when he retires. So as you can see, almost every 10 years of delay in savings for retirement, the lump sum that the individual is expected to get is going to drop by 50% for every 10 years. And we talk about for individual who is in early 20s, started saving from 20 years old to 30 years old, we're talking about 10,000 ringgit per year over 10 years. It's only 100,000. That's not even equivalent to the price of a decent car, right? So my advice is instead of especially for the younger individuals, I'm past that age. I'm 43 years old already. So I wish somebody had told me when I was 20 years old, instead of buying a new car and pay for the interest for your car loan, instead you can save for your retirement and earn interest. I think that's that's what I call the power of compound interest. A lot of very wise men in the mankind have quoted this. The power of compound interest is one of the strongest force in our economic environment. So I was going to share that quote from Albert Einstein. He said that compound interest is the 8th wonder of the world. Those who understand it, they earn it, and those who don't, they pay it. So.
Yep, very, very true. Thank you very much. That's excellent. Can I just want to interject something here. As you know, I currently reside in Singapore. Saving is I come from a very bad history of not saving for anything. I don't know whether it's just me, but I think a lot of us in the audience, we don't save. We just live from I live from paycheck to paycheck for a very long time. How do we encourage? Encouraging is one way, but very difficult to change behavior. I guess this forum is trying to educate the young on how to be able to save. Now, the other way is if you don't want to save, I like the Singapore way, we force you to save. Okay? So, Singapore, we are 37%, the highest saving, 37% goes to CPF. They don't take that from me because I'm too old. They say I can't. I want to. They don't allow me. So would Malaysia or would there be a product that can, in a way, increase the saving? And so at least when I put that percentage into the saving, I get tax relief. Is there something like that to increase the saving? Because currently EPF is not it's less than that. It's 20%, right? Total?
22, I believe.
Yeah, 22.
It's about 22, yeah.
22. So I mean, one way of forcing, like, the compound interest and things like that would be to push it up. Is there any product apart? I mean, my own personal EPF. Is there something I can do like that?
I think you're staring at the PRS, right? Encik Huzaini just mentioned the PRS. It is something that you can add in addition to your EPF. There is a forced saving element in the sense that you can't withdraw the money before you turn 55.
Okay.
Yeah.
Okay. So, but do you get sufficient tax relief? So that's my question, is it?
You get a tax relief of 3,000 per annum.
Okay. Okay.
Yeah.
There is a question from the audience. So we do have a significant number of audience who are virtual. So can I just put that to this? Sabrina has asked, I'm concerned with the money I invest in PRS if the admin fees are much higher than EPF, and what is the reason for that? And is there any way that they can be overcome?
Yeah, I can take that
question. For you.
Yeah, I can take that question. I think the Sabrina management fees is because management fees are charged by asset management companies or providers in order to manage the funds. And I'm not going to comment so much on EPF, but other than to say that they also incur costs, as part of running the fund. But you need to go and look at their annual report to see how much they actually charge or they incur costs. Because it's not, when you don't see it doesn't mean it's not there. It's just that for PRS, everything is listed in percentage upfront. But if my advice is, if you are concerned about the funds that you have that is attracting high management fees, you can consider other funds in PRS which have lower management fees. Typically, the higher risk funds would attract higher management fees, but the lower risk fund like conservative, something like that, or balanced fund, or balanced fund. I cannot remember what we call in PRS. Balanced funds in general also attract lower management fees compared to high risk.
I think this is one of the concerns as a consumer. When you look at it, they tell me, 5% return, but the management fee is 1% of that 5% or something, or maybe 2%, and then you are in a way kind of deceived. I find that a bit difficult because that's not in the computation. So I think people should be made aware.
When you see a return of 5%, it's already net off the fee.
Okay.
Yeah, it's not like it's taken from the 5%. No, it's only.
Okay. All right. So I think that's one of the important things. Anybody else to add something? Yes.
Yeah, Dr. Vai, whatever published performance numbers by, I believe most of the, or not all of the asset manager are net of fees. So whatever, when we publish 5%, you are actually getting the 5%.
Yeah. Okay.
Okay. But the caveat is that does not include the sales charges.
Yeah.
Right? For our PRS, there is 0 sales charges. Yep.
Yeah. Okay. I think we just got about 10 minutes more. I'm just going to move on a little bit. So for what I just want to ask, the whole panel, in fact, but in terms of insurance, most people, neglect insurance. How would insurance play its part in somebody's looking at the retirement, and how would that, and what are the shortfalls that most individuals have in getting insurance? Yeah.
Thank you, Dr. So I should prepare some pointers, to address this. Of course, as I said, upon retirement, the risk is actually living too long. Whereas when you are still working, your risk is you die prematurely, and then your families will be left without the breadwinner, right? So the risk of living too long. How can insurance help? I would say, in the market, there are, of course, insurance products that target, retirement savings. Of course, the proposition would be to provide very stable return. I would say it forms a very important part of your overall asset portfolio. I'm not saying you should put all your money in insurance, but I'm saying that you should at least have, I would say, 10 to 20% of your money in insurance, just that, you provide, first of all, diversification. We all learn to know not to put everything in one basket, right? Insurance can provide that kind of peace of mind for you, in terms of very stable return. Of course, insurance can also provide protection, while you're still working, you're planning for retirement. And some insurance products are designed to as a target savings kind of product. You pay, while you're working, and then you accumulate it, and then when you retire, you get a lump sum, either a lump sum or streams of income, upon retirement. It could be 10 or 20 years and so on, depending on which product you pick. And also, I would say medical insurance is also very key, for retirees. I understand, most of you are healthcare professionals here. You probably have, employee benefits from your employers, and so do we, right? So, but it's when you retire and you lose that kind of employee benefits. That's when your body, your health start to show problems. You guys are the expert. You know what I'm talking about, right? And at that point, any medical treatment could cost you your lifelong savings. So I think medical insurance is also very important for a retiree. And lastly, I would say retirement is a long-term savings plan. It's not about saving 5 years and then you get 30 years of retirement. It's about long-term saving, and you accumulate bit by bit. You have to start early, rather than later. To, as I said, the power of compound interest is very, very powerful. In terms of savings for retirement. In the long run. Oh, there's one more thing I would like to add. If you could go to this page. I also want to talk about insurance leverage, especially, I understand the audience, you guys, professionals. Insurance leverage is about, I'll use a very simple example. If you can look at the right side. Just an example, very simple example. John is 50 years old and has total assets of 1 million. So we're talking about, he's trying to leave some money for his families, after he passes away. So without insurance, he has 1 million exactly, right, to leave for his family. However, assuming that he spent half of it, 500,000, to get an insurance policy of say 1 to 2 million, say 2 million ringgit of coverage, then he can create wealth through an insurance instrument of a total of 2.5 million, because he still have half a million left in his assets, and he has a 2 million ringgit worth of insurance policy. So his family now is left with 2.5 times of what he originally has, in case anything happens to him. And John can also decide to utilize the remaining half a million ringgit to improve his lifestyle during his retirement. So that tells you the power of insurance leverage. And I also understand that in the current market, there are some high net worth insurance proposition where you can work with a bank. They can give you a loan on your premium to further amplify that what we call financial leverage. The prevailing borrowing rate for US dollars is about 1% at this point, and most of the US dollar denominated product will be able to provide more than that. So your insurance policy values outgrows your of course you have to service the loan, but it outgrows the interest payment that you have to make. So I think that's a very powerful and very popular insurance proposition for high net worth, even ultra high net worth individuals. At Sun Life we have seen insurance policies in the range of 50 million to 100 million US dollars in terms of coverage. And these are very, very wealthy individuals. They don't need money for retirement or to pass on to the next generation, but insurance can help them create wealth, to increase their overall wealth. I think that's what I wanted to share with you.
Thank you, thank you. Just, we only got about a minute, so 30 seconds. Steve, last word.
From me.
Yeah. 30 seconds.
Start savings early lah. Start saving like yesterday.
Okay.
I have exactly the same chart as Patrick, essentially showing you if you were to save 1,000 ringgit for 8%, I'm talking about, let's say, a dividend fund, 1,000 for 30 years, that's 1.4 million. Okay, just
Yep.
1,000 a month. So 10,000 a month, if you are very, very high income earner, if you can send 10,000 a month, that's 13 million, okay, at the end of your working life. Yeah.
Thank you. Hussaini, 20 seconds. You're muted.
Okay. No, I just want to say, apart from retirement planning, insurance planning, investment planning, all that, we should also look after our health, so that when we go toward retirement, we are healthy enough to enjoy the fruits of our labor. We can go around the world, look after, can see our grandchildren grow and so on. Yeah, look after our health as well.
Thank you very much. I think we are just on time. Thank you, everybody. Just a word from the sponsors. They do have a booth. Alex, can you put up something on the booth? For those who need to have more information, there is a booth by the Afin Wang Group. Please do drop by and discuss with them. And I think it is definitely timely for everybody to think about retirement. It's never too late. Thank you very much. I hand it back to the organizers for the next section. Goodbye.
Bye.
Everybody.